Good morning, everyone. Good afternoon for others. Today, we're going to go over the different types of equity. So we're going to talk a little bit about net income. And what is net income? It's the amount that is remaining after subtracting your expenses from your total revenue. So you take your expenses from your total revenue and you get your net income. The next word we're going to go over is retained earning. So this is an amount that is calculated or accumulated from the net income from previous years. And what you do, it is minus from any dividends paid to shareholders. So you'll see that this is a part of the balance sheet. So this is accumulated net income from previous years minus any dividends paid to shareholders. Next thing we will see is what we call common stock. So nowadays you can go and you can buy stocks in your portfolio. You can buy it from various companies. Sometimes you can get it from Robinhood. You can get it from any company that you can get a 401k. So those are what we call common stock. So it's a capital the business received in exchange for issuing stock to stockholders. So dividends. Dividends are what the business pays out to shareholders. Again, dividends are what the business pays out to shareholders from business earnings. So the next thing that we're going to talk about is comparing ownership. So bookkeepers must compare the different type of business ownership and understand how they affect each financial record keeping. So what are the different types of ownership? So proprietorship, partnership, corporation, or non-profits. So in each part, please make sure you read this. Inside of your course, you read the retained earnings, so proprietorship and partnership. Then also make sure you read the membership units in the LLCs. Make sure you understand the stockholders' equity, and that comes with what? The C corporations. Also, you see stockholders' equity in where? S corporations. Next thing, please understand what they call net assets. So, nonprofits. In a nonprofit, no one owns a net profit, so there's no equity. So what you'll see is net assets on the balance sheet. And net profits receive investments and contributions to support their missions. So let's go over the first question. As an owner of a partnership withdraws money often from business profits, because a partner doesn't receive a paycheck from their business, withdrawing business fund is how he pays himself for work. What is this fund called when funds are taken out? So that's the first question that you would see. So what is that fund called when funds is taken out? Let's go with partners draw. All right, so that's what we call partners draw. Now let's go to the next question. When funds are added to create a corporation, what are the funds called? So we have S corporation, we have C corporation. What would they have? They would have what we call company stock purchases. Now, we're going to go to the next section, section 3 of 7, which talks about impact of equity transactions. So equity transactions are big deal for small business owner. And what do? They help owners raise money by selling shares or bringing in investors. Again, the owners raise money by selling shares or bringing in investors. So how many types of equity transaction? You have capital contributions, you have owners and partners draws, and you have profit contribution. So what I want you to do is to read what these are. So the capital contributions are the funds or asset that owners or investors contribute to a business to finance its operation or support its growth. Then you would watch this video. Okay, then you'd look at what we call owners and partners draw. So the owners and partners draw, it refers to the money that they're taking out, right? Or assets by owners or partners from the business for personal use. So whether they take out money or they take out assets from the business for personal use, that is what we call owners draw. So when they take out this money, they're sometimes taking it out for themselves. And the owners draw impact the equity of the business. So owners draw and partners draw are not the same as salary or wages. So who takes the draws? The owners or partners who actively participate would take the draws. And again, it's based on their ownership or partnership interests. The next topic is closing out the year. And when they talk about closing out the year, they're talking about retained earnings. So they would transfer the balance of this account or transfer balances to retain earnings. So they would reconcile the books for the owner's capital or investment account and owner's draw. And then they transfer the balance of this amount to retain earnings. So that is what we call closing out the book. The first thing that we're going to do here is the money or assets given to the business by the owners or partners. What do you call that? So they give money. What do you call that? That would be a contribution. The total of subtracting all expenses, including taxes, from the total revenue. All right, so we're talking about taking money, subtracting expenses from the total revenue. That is called net profit or income. Next one. When an owner takes funds from their business holding for individual use, what do we call that? That's called a draw. The amount of money that an owner has invested in the business minus the amount of money that the owner has taken out of the business. So when they take it out, it's called a draw. So they invest it. Now they have taken out money. What is the difference of those two called? It is called the equity. So we have finished under that section. And now we're going to look at calculating total equity. Remember, we have been doing this for a while. So in this area, we talk about assets equal liabilities plus equity. Now we're just taking this same formula. And what are we saying? Equity equal assets minus liabilities. So remember, All you're doing with that formula is you're changing it around. So it would be assets equal liabilities plus equity. So now all we're calculating is for the word equity. Everybody see that? You're calculating for the word equity. So equity would be what? Assets minus liabilities. So the next thing that they show you is they're setting the scene, and then they're talking about being a bookkeeper for a small flower shop. Again, they're looking at you being a bookkeeper for a small flower shop. And then they're giving you the example of the owner's investments of $28,000, the owner's draw of $1,000, and if you minus the two, you see that it comes up to $27,000. Then they give you what they call the retained earnings. They give you the net income. And what do they want you to do? They want you to calculate the total equity. So how do we calculate the total equity? We take the owner's investments minus the $1,000 from the owner's draw. You get the $27,000. Then we're looking at the retained earnings and the net income. We take the retained earnings and the net income, we add it, and we get the owner's equity of $36,500. Now, let's go to lesson 4 of 7, where they want us to try it out. So here they're telling us about the statement of equity. And now they give us a owner's investment for $60,000, owner's draw for $5,000, total investment $55,000, retained earnings $15,000, and net income $20,000. So what would be your total equity? Remember the formula that they just showed us. And in this formula, they told you the owner's investment they told you that part right here is the $60,000. Then you're going to minus the owner's draw. So the total owner's investment that you have right here is the $55,000. Now that you have got this money, what are the two amounts that you add back? You're going to add your retained earnings. And remember, retained earnings comes from prior year. And when you add your retained earnings of $15,000 and $20,000, what amount do you get? That should be about $90,000. Everybody, you should have gotten about $90,000. So let's go ahead and look at that. How much equity does the owner have? Let's go ahead and select the $90,000. So that's the correct amount of money. And if you didn't see it in the first area, here it is calculated for you. Right at the bottom, it shows you how to calculate the owner's equity. Now let's look at what we call the income statement. And the income statement, you can see the total income of $55,475.25. Then they give you the cost of goods sold of $22,343.75. You subtract these two amounts and you get what we call the gross profit. So now that we got the gross profit, we're trying to calculate the net income. So the gross profit minus the total expenses give you the net income. So what do? We take 33,131.5. We're going to minus, make sure this is done on the screen. We're going to minus 10,256.82. And what amount does that give us? That should give us 22,874.68. Let's see if you got that. 22,874.68. Now, let's see what questions they have for us. So what is the net income for the month of June? We're going to go ahead and select 22,874.68, and then we submit. Next, we have what we call the transaction journals. So here, they're showing us assets, and they're also showing us the equity. And here, they're telling us that the business owner makes a capital contribution to the business of $5,500. So he makes a contribution, money going in. So what happens to the assets? Does the asset increase or does the asset decrease? That's correct. The assets increase. So when the assets increase, what do? Do you debit or do you credit? Remember from what everyone calls the dealer. Keep that in your head. So remember dealer. A quick way to remember. So the first one is dividends, expenses, and assets. So here, the first three are debited, normally debited. So now that we know that the first three is debited and we make a capital contribution, that means our cash is going to increase, which is an asset. So our assets will be debited. So let's make a note right here. Our assets would debit because money is in. Now, the owners make what we call a capital contribution. Okay? So what the capital contribution does, it increases our equity. So in the last section right here of the dealer, LER, liabilities, equity. I hope I remember it right. All right, so all these, the last three What do you do with them? These are all credit. So liabilities, equity, and revenue are normally credited. So if our equity is going up, what are we going to do? We are going to credit. So keep that in your notes. So we make a contribution. So assets went up and our equity went up. So now that the assets went up and our equity went up, let's look and see how we are going to do this, right? So let's look at it says based on the capital contribution of 5,500, which should be credited and debited. So we're going to debit our assets of 5,500 and credit equity of 5,500. So let's go ahead and submit. Now, the next thing we have is what we call a transaction journal. So with the transaction journal, we see that the owner, right, got paid. He got paid an amount of $4,567.12. So if you read that, it says he completed a project and he got paid $4,567.12. So what the owner did was took the money and put it into his personal bank account. Notice his personal bank account. So they're trying to say to you, what do you do to fix this problem? He put in his bank account instead of into the company. So what you're going to do, in this case, you're going to debit what we call the owner's draw by $4,567.12. So what we're going to do is debit the owner's draw by $4,567.12. And what are we going to do with the revenue? Because the revenue still belongs to the business. We are going to put it into the revenue. So the revenue is going to go up because money came in of $4,567.12. Everybody understands that? So the questions that follows, let's see if we can answer them. The question says, based on the owner keeping the payment, which account should be credited and debited? So we would debit the owner's draw and credit the consulting revenue. Again, we're going to debit the owner's draw and credit the consulting revenue. Now, we have what we call the summary activity. And you can read the scenario. He wants to purchase an item that will enhance the services, and he has cash available. So the question is, what should I do? And you would tell him, it's great. Looking at this, it's great you're looking to improve your services. One option would be make a capital contribution to the business, which can help the purchase of the item. Then you go ahead and submit that. So he makes a capital contribution to the car wash business. He makes a contribution to the car wash business. How would you record his capital contribution? How would you do that? How would you record the capital contribution? Money's coming in. So we would debit the asset account and also credit the equity account. And then we submit. Now, a month later, your client withdraws $8,000 from the cash account for personal expenses. How would you record the withdrawal from the cash account? So I would debit the owner's draw and credit the cash account. So those are the first things that you would do. And then later, I'll go over, show what you know in terms of this exam. Again, I'll go over, show what you know in terms of the exam.